Fund accounting is unique to nonprofits and to governmental agencies. Understanding funds and the proper implementation of fund accounting will provide better information to the board, provide more meaningful financial statements to funding sources and to the general public. The emphasis of fund accounting is accountability, not profitability. The reason being is all of the revenue received by nonprofit organizations is designated for a specific purpose. Therefore, an organization must set up their financial records to reflect the characteristics of the revenue they receive. A fund is like a separate set of books within your organization. It's like having multiple companies. Each company has its own set of assets, liabilities, revenue, expenses, and at the end of the year, each company's excess or deficiency or profit and loss must be reflected in that fund's net asset account or fund balance. There are certain types of characteristics applied to each of your funds. There's your unrestricted fund, where there are no strings attached to the revenue that you receive. There's your temporarily restricted fund, where there are some strings attached. Then there's the permanently restricted fund, where there are strings attached by the donor as to the use of those funds. Let's talk about the unrestricted fund. This fund represents money received by your organization that has absolutely no strings attached. Donations that come into your organization where the donor does not specify a specific purpose can be used by management for the general mission of the organization. This fund is typically referred to as your general unrestricted fund or general operating fund. The next fund is the temporarily restricted fund. These funds do have strings attached because the grantor or donor wants their money to be used for a specific purpose. Typically, in the temporarily restricted fund, there is a time restraint as to the use of those funds. So when the organization expends the money for the designated purpose of those restricted funds, the organization can then release those funds from the temporarily restricted fund to match the expenses they were intended for. Finally, there's the permanently restricted fund, which is sometimes called an endowment. This is where the donor donates money to your organization and does not want their gift or principal to be touched. So the nonprofit must then invest that money, properly manage that investment money, and then the earnings from that endowment can be used for the general purpose or the benefit of the organization. Sometimes those permanently restricted funds have a designation where the interest earned and earnings from that endowment can be used for, let's say, a scholarship. That's very typical for an endowment. So we have the unrestricted fund, the temporarily restricted fund, and your permanently restricted fund. So those are the three main categories of funds. But there are also subcategories of funds which actually fall under the unrestricted category. These are sometimes called board-designated funds. Let's say your organization has a specific project that the board wants to set money aside for. The board can actually set aside a specific fund for that project underneath the umbrella of the unrestricted fund. You can also set up a fixed asset fund. The purpose of this is to separate your buildings, your equipment, your furniture, and fixtures from your general operations. This provides the board and the general public with information as to the actual expenses it takes to run your program, while not including fixed asset purchases and the depreciation to maintain all of your assets. These are not necessary. Typically, they're board decisions and can be incorporated into your financial picture. With appropriate understanding, there's nothing difficult about fund accounting. It basically reflects mechanics as to the recording of revenue for its designated purpose and matching it with your expenses. It is critical for nonprofits and governmental agencies to follow these principles because the money they received is designated for specific purpose and must be used to provide proper accountability and stewardship of those funds. With the proper system, you can very easily generate financial statements that reflect your organization's financial health in each of your three funds: unrestricted, temporarily restricted, and permanently restricted funds.